While the world focused on price spikes, social feeds, and intraday charts, the real event happened at industrial vaults and clearing facilities. Screens showed volatility, warehouses showed absence. Paper claims continued to trade, dense, liquid, confident, while physical silver moved slowly, under guard, measured in pallets instead of contracts. Two markets existed at once. Only one required delivery. This was not a surprise. It was a reconciliation. For years, leverage expanded in silence. Liquidity appeared infinite because settlement was optional, deferred, abstracted. Arbitrage smoothed every signal. Margin rules absorbed stress before it became visible. The system learned to survive by postponement. Then a constraint surfaced that could not be rolled, rehypothecated, or netted out. Physical metal. What followed was not a crash, but a sequence. Procedural, lawful, irreversible. Each response narrowed the exits. Each safeguard transferred risk elsewhere. Each rule change confirmed what could no longer be denied. This is not a forecast. It is an autopsy conducted in real time. The price was only the noise. What visibly broke was confidence in price movement. Silver prices surged, headlines followed, charts accelerated. The public saw volatility and assumed discovery. What actually happened was suppression through participation. On the screen, liquidity appeared deep, orders filled, spreads held. The market absorbed demand without disruption. Commentators framed the move as speculative enthusiasm, retail pressure, or momentum. Off the screen, nothing moved. No surge in outbound shipments, no corresponding drawdown in deliverable inventory, no acceleration in refinery throughput. The dock was silent while the screen screamed. This divergence mattered, because when prices rise without physical response, it signals not strength, but absorption. Pressure was not released. It was redistributed. The system did not reject demand. It diluted it. The mechanism was procedural, not conspiratorial. Step 1. Rising prices triggered arbitrage incentives. Futures, options, and ETF shares offered synthetic exposure faster than physical metal could be sourced. Paper supply expanded elastically. Step 2. Arbitrage desks sold that exposure. They captured spreads by creating new claims, not by delivering metal. This increased liquidity on the screen while removing urgency from the physical side. Step 3. Margin pressure followed. As prices climbed, exchanges raised margin requirements unevenly. Smaller participants faced forced deleveraging. Larger institutions absorbed the flow. This acted like a queue with a controlled entrance. Those without balance sheet capacity were pushed out. Those with capacity moved forward, concentrating exposure. Step 4. Institutional exposure deepened. Banks and market makers held growing paper obligations tied to metal that was not being sourced. Liquidity remained visible, but it was no longer neutral. It was directional. The analogy is a vacuum. Liquidity was pulled forward from the future, filling the present, while leaving an absence behind it. Nothing snapped. Everything stretched. Margin hikes came first. They slowed retail participation while protecting institutional continuity. Stress was redistributed upward. Next came subtle throttling. Intraday volatility controls. Position limit reminders. Risk circulars issued quietly to members. These steps reduced visible disorder while increasing internal strain. Historically, this pattern repeats. In 1980, silver rules were changed only after concentration became undeniable. In 2008, liquidity froze only after balance sheets were saturated. In 2022, nickel trading halted only once price discovery threatened solvency. The rulebook never stops risk. It moves it. Each intervention preserved order while narrowing exits. Each delay increased the cost of resolution. Force majeure was not invoked, but it entered internal discussions. That was the signal. Dealer premiums began to widen despite stable screen prices. Small, then persistent. A disconnect, not an outage. Delivery timelines lengthened. Weeks became estimates. Estimates became conditions. Inventory classifications mattered. Eligible metal remained steady. Registered metal did not grow. The distinction was technical. The implication was physical. Industrial demand showed no retreat. Fabricators reported normal intake. No substitution. No slowdown. The silence at the dock continued. This was not a shortage event. It was a containment phase. And containment only works while belief holds. What visibly broke was nothing. Inventory reports remained stable. Daily settlement continued. Exchange statements showed adequacy. The public saw reassurance. What actually happened was restriction. Metal listed as available did not move. Withdrawal notices slowed. Confirmations became conditional. The vault doors did not close, but they stopped swinging freely. On the screen, contracts cleared. At the dock, pallets stayed put. This was not depletion. It was immobility. Silver existed. It simply could not respond on demand. Some bars were pledged multiple times. Others were committed to industrial users. Some were stored in locations where transport was slow, regulated, or politically sensitive. Ownership and availability diverged. The system continued to function because it redefined what available meant. The mechanism unfolded quietly and lawfully. Step 1. Paper claims accumulated faster than physical metal could be mobilized. Futures, unallocated accounts, and ETF structures reference silver without assigning specific bars. Step 2. Arbitrage incentives encouraged this expansion. As long as delivery was unlikely, selling paper against physical scarcity remained profitable. Liquidity increased on the screen while physical optionality decreased. Step 3. Liquidity removal began at the vault level. Bars already pledged could not be reassigned. Metal stored abroad could not move quickly. Operational bottlenecks replaced theoretical supply. Step 4. Margin pressure surfaced indirectly. Clearing members responsible for delivery guarantees faced rising internal stress. They did not default. They delayed. This acted like a bottleneck. The flow existed upstream. The exit narrowed downstream. Institutional exposure increased because responsibility was concentrated. A small number of entities now stood between paper claims and physical reality. The system held because time was bought. Time was the only buffer left. The first response was administrative. Withdrawal queues lengthened. Delivery windows widened. None of this violated rules. Next came procedural reinforcement. Inventory categories were emphasized. Eligible versus registered became central to communication. Responsibility shifted without metal moving. These steps reduced visible panic while increasing latent stress. History rhymes here. In 1980, rule adjustments followed concentration in silver holdings. In 2008, liquidity appeared until it did not, and then it vanished everywhere at once. In 2022, nickel trading was halted only after settlement integrity was threatened. The pattern is consistent. Containment precedes acknowledgement. Force majeure was not declared. But the logic was prepared. The preparation was the escalation. Dealer premiums continued to rise independent of futures prices. Not explosive, persistent. Delivery timelines stretched further. Available became pending. Pending became conditional on location and form. Inventory reports showed stability, but composition shifted. Eligible metal remained high. Registered metal did not replenish. The distinction was technical. The consequence was physical. Industrial demand showed no elasticity. Fabricators did not reduce orders. Long-term contracts remained in force. Physical draw continued. The silence in the vaults deepened. This was the hidden event, not the loss of silver, the loss of confidence that silver could be summoned on demand. What visibly broke was pricing cohesion. On the screen, silver continued to trade. Futures rolled. Options repriced. ETFs tracked benchmarks with mechanical precision. To the public, the market still functioned. When what actually happened was separation. Paper claims multiplied while physical responses stalled. Requests to convert exposure into metal increased, quietly at first, then persistently. Cash settlement incentives were offered. Rollovers were encouraged. Delivery was discouraged without being denied. The screen showed continuity. The dock showed friction. This was the moment when paper and physical stopped behaving as equivalents, even though they remained contractually linked. The system did not fail. It diverged. The mechanism was embedded in design. Step 1. Delivery optionality became active. Futures contracts allowed for cash settlement. Unallocated accounts promised metal without assigning bars. These features reduced immediate strain under normal conditions. Step 2. Arbitrage incentives collapsed. As physical premiums rose, paper prices no longer reflected true acquisition cost. Spreads widened beyond risk-free capture. Arbitrage desks stepped back. Step 3. Liquidity removal followed. With arbitrage gone, paper markets lost their shock absorbers. Liquidity thinned precisely where demand concentrated. Step 4. Margin pressure intensified. Volatility triggered higher requirements. Leveraged participants exited. Exposure consolidated further among institutions, obligated to maintain markets. This resembled a margin call in slow motion, not a sudden demand for cash, but a steady narrowing of acceptable collateral. Institutional exposure deepened because exit paths closed. Selling paper no longer guaranteed neutrality if physical obligations remained. The system absorbed stress by concentrating it. Margin hikes accelerated the divergence. They reduced participation while increasing volatility sensitivity. Trading halts were discussed, not implemented. The threshold was watched closely. No one wanted to repeat 2022's nickel episode unless forced. Rule interpretations shifted. Cash settlement language was emphasized. Flexibility became policy. Each step preserved surface order while increasing systemic stress. History offers parallels. In 1980, silver trading rules changed once concentration threatened delivery. In 2008, markets remained open until liquidity disappeared entirely. In 2022, halts arrived only after price discovery endangered clearing integrity. The pattern is delay, then intervention. Force majeure remained unspoken, but its shadow lengthened. Dealer premiums decoupled fully from futures prices, not briefly, structurally. Delivery delays became standardized. What was once exceptional became routine. Timelines were extended without explanation. Inventory categories grew more rigid. Eligible metal stayed high. Registered metal declined incrementally. Conversion slowed. Industrial demand remained firm. No substitution occurred. Fabricators continued to draw metal, indifferent to paper price behavior. The dock remained active. The screen grew abstract. This chapter marked the point of no return. Once paper and physical diverge, reconciliation does not occur through negotiation. It occurs through constraint. What visibly broke was market depth. Spreads widened. Volumes thinned. Quotes remained, but they no longer invited size. To the public, this looked like caution. A pause, a rational response to volatility. What actually happened was retreat. Institutions began to step back simultaneously. Market makers reduced exposure. Banks reevaluated commitments. Credit lines tied to metals desks were reviewed, then constrained. The screen still functioned, but it no longer absorbed pressure. At the dock, requests accumulated. In balance sheets, tolerance disappeared. This was not fear of price, it was fear of obligation. The mechanism followed institutional logic. Step 1. Internal risk models recalibrated. Rising volatility and widening basis spreads increased capital charges. What was previously neutral became punitive. Step 2. Arbitrage incentives vanished completely. Without confidence in physical availability, no desk was willing to warehouse risk, even temporarily. Liquidity providers became liquidity preservers. Step 3. Liquidity removal accelerated. Quotes were pulled. Size limits imposed. Markets remained open, but only nominally. Step 4. Margin pressure cascaded inward. Clearing members faced higher requirements while their ability to hedge declined. Exposure became asymmetric. They could not exit without amplifying stress. This resembled a vacuum. Liquidity was not withdrawn evenly. It was sucked away from points of stress first. Institutional exposure peaked precisely as flexibility disappeared. The entities tasked with stabilizing markets now carried the most risk. The system did not panic publicly, it locked internally. Margin hikes intensified, not to control speculation, but to protect clearing integrity. Each increase forced further deleveraging. Trading halts became contingency plans. Scenarios were modeled, thresholds were defined. Rule interpretations shifted again, settlement discretion expanded, timelines became adjustable. These steps mirrored history. In 2008, liquidity froze before any formal closure. In 2022, nickel trading was halted only after margin calls threatened member solvency. In 1980, silver rules changed when concentration made delivery untenable. The lesson is consistent. Institutions act before markets acknowledge. Force majeure discussions move from legal departments to executive briefings. That transition mattered. Dealer premiums spiked in specific forms. Bars moved faster than coins. Large orders faced rationing. Delivery delays became opaque. Explanation stopped. Silence replaced guidance. Inventory reports showed stability in aggregate, but drawdowns in specific vaults. Transfers slowed. Conversion stalled. Industrial users began reporting longer lead times. Not shortages, scheduling friction. The dock was no longer quiet. It was congested. This chapter marked the shift from market stress to system stress. Once institutions retreat together, liquidity does not return on its own. What visibly broke was neutrality. Rules changed, quietly, incrementally, officially framed as risk management. To the public, these adjustments appeared procedural, technical, temporary. What actually happened was containment. Margin schedules were revised again. Position limits tightened in practice, if not in headline. Settlement language was clarified. Flexibility was emphasized. The screen showed continuity. The rulebook showed intent. Nothing halted outright, nothing defaulted. But the framework governing obligation shifted under stress. This was not intervention after failure. It was intervention to prevent acknowledgement. The market still functioned. The contract had changed. The mechanism was legal and mechanical. Step 1. Escalating stress triggered governance thresholds. Clearinghouses are designed to survive member failure, not systemic delivery mismatch. Policy tools activated. Step 2. Arbitrage incentives were formally neutralized. Cash settlement pathways were highlighted. Delivery optionality became the preferred outcome. This reduced immediate physical strain while increasing long-term divergence. Step 3. Liquidity was selectively preserved. Markets remained open, but under new constraints. Participation without balance sheet depth became impractical. Step 4. Margin pressure finalized concentration. Only institutions capable of absorbing rule uncertainty remained active. Exposure centralized at the core. This resembled a queue with a locked exit. Movement continued. Resolution did not. Institutional exposure transformed from market risk to legal risk. Performance depended not on price, but on interpretation. The system survived by redefining success. Margin hikes were no longer reactive. They became preventative. Stress was priced in advance. Halts were modeled, not executed. The threshold moved closer. Rule changes hardened. Temporary language lingered. Flexibility became precedent. History is explicit here. In 1980, silver rules changed to cap exposure. In 2008, emergency facilities altered market function. In 2022, the LME canceled trades to preserve clearing solvency. Each case followed the same logic: preserve the institution, redefine the outcome. Force majeure entered official documentation as a contingency, no longer hypothetical. Once written, it cannot be unwritten. Dealer premiums accelerated beyond rational explanation, not panic pricing, defensive pricing. Delivery commitments became conditional on form, size, and timing. Large orders were deferred, small orders rationed. Inventory categories hardened further. Eligible metal was acknowledged but functionally inert. Registered metal declined or stagnated. Industrial demand did not retreat. Fabricators adjusted schedules. They did not cancel. The dock was constrained by policy now, not logistics. This chapter marked the transition from market adaptation to systemic protection. When rules change to manage reality, reality has already won. What visibly broke was settlement confidence. The screen still printed prices. Contracts still cleared. Official statements emphasized continuity. To the public, the system appeared stressed but intact. What actually happened was depletion of trust. Physical silver continued to leave the system, not in a rush, in a sequence. Industrial users took delivery. Private holders withdrew. Sovereign channels accumulated quietly. Bars exited. They did not return. The dock moved steadily while the screen remained abstract. Each successful withdrawal reduced the pool backing outstanding claims. Each confirmation tightened the constraint for the next request. This was not a run. It was an orderly drain. And orderly drains are the most dangerous. The mechanism was mathematical. Step 1, rule uncertainty altered incentives. When settlement terms become flexible, possession becomes priority. Holders of paper claims reassessed risk. Step 2, arbitrage incentives inverted. Instead of selling paper against physical, participants sought physical against paper. Premiums justified the move. Step 3, liquidity removal became permanent. Metal leaving vaults reduced optionality. Each departure increased marginal stress on remaining claims. Step 4, margin pressure transformed into performance pressure. Clearing members faced obligations that could no longer be hedged through acquisition. Exposure was no longer financial, it was logistical. This functioned like a margin call without cash. Obligations rose, collateral vanished. Default risk emerged not from insolvency, but from impossibility. The system could remain solvent while failing to deliver. That distinction mattered legally. It did not matter operationally. Margin hikes lost relevance. They could not create metal. Halts remained unused. Stopping trading would not restore inventory. Rule changes reached their limit. Flexibility could delay recognition, not resolve constraint. Force majeure moved from contingency to probability, not as an event, but as an option that narrowed toward activation. History aligns here. In 2008, liquidity facilities delayed defaults but could not force lending. In 1980, silver delivery rules changed because physical could not be sourced. In 2022, nickel trades were canceled because settlement threatened clearing survival. Each case ended the same way, through acknowledgement of limits. Dealer premiums reached levels inconsistent with futures pricing, not volatility, structure. Delivery delays became indefinite for certain forms. Availability depended on size, relationship, and timing. Inventory reports showed continued presence of eligible metal. Registered inventories failed to stabilize. Conversion rates slowed further. Industrial users began securing supply directly. Long-term contracts replaced spot reliance. Physical bypassed exchanges entirely. The dock was no longer part of the system. It was the system. This chapter marked the transition from stress to resolution. Once physical exits accelerate beyond replenishment, outcomes are no longer negotiated. They are enforced.